Good morning, everyone, and welcome to BFC1010. I'm Richard Driscoll. I'm going to be lecturing you guys for the year, groups 1, 3, and 4. As you know, there are a few lecture problems at the moment, so that's why I'm making this video, just to welcome you all to Accounting Fundamentals. There you can see this will be the textbook that you will be working from. It's available at Van Schaik's, a very nice little textbook that some of the lecturers have put together. So what you're going to need to do is read chapter 1. I'll briefly just do a thing on ethics, then we're going to look at accounting terminology and the accounting cycle. Now, if you haven't done accounting before, there's no need to worry because we're starting from the beginning and we will work through all the terminology and you're actually going to enjoy this module. You would have received a module guide in an email, so just have a look at that. When we get together face to face, I will go through the module guide with you, as there's certain criteria you're going to have to fulfill to get a credit for this module, but we'll look at that when we meet face to face. Right, ethics in your life, workplace, and accounting. I'm just briefly going to have a look at this. But ethics are the principles and values that guide people in deciding what is right and fair and responsible. It's essentially the framework we use to judge good conduct and make choices that respect others in society. So ethics is all about what you've learned in your environment, what is right, fair, and responsible. But more importantly for us, a good work ethic, or for you, is to be consistent. You consistently need to be working on your studies. You need to stay motivated even when the going gets tough. You need to manage your time well, and you need to put in some real effort into learning and completing tasks. The exercises that your lecturer gives you, it is very important for you to complete them properly. These exercises will prepare you for tests and the exam. A good workplace ethic is about acting with integrity, being responsible and professional, contributing positively to the team and the organization's goals. But with this ethics here, I was more concerned about the characteristics that you have to develop for your own good work ethic. And then in accounting, what it means to have good accounting ethics, you need to work honestly, accurately. The information that you're going to produce needs to be trustworthy, so informed decisions can be made, and all this information needs to be transparent. While we're on the subject of ethics, just something that touches on that is when I give a lecture, or any of your lecturers do lecture, there needs to be silence so everyone will remain focused. There will be a time for questions and teamwork and group work, but during a lecture you need to be considerate to the lecturer and to those people around you. Minor distractions can break your concentration and make the content actually feel harder than what it is. So please, the lecturers don't need competing noise. You're here to work and study and become more knowledgeable. The more knowledge you have, the more chance you have of success. And the accounting fundamentals is a life skill. It is very important, and it will help you through life to have the basics of accounting. If you are late for class, please enter the back of the classroom and sit at the back so you don't disturb the class. We, the lecturers, are here to serve you and make things better for you and to give you good quality information and make sure we do our part. But remember, the responsibility and the onus is on you. Get that textbook. Right, just some background. In all the videos created for BFC1010, I use a case study, Calibre Education, a business that creates accounting videos, and what they do is they buy and sell from creditors and sell to debtors. And you will always be doing, in my videos, work from the point of view of Calibre Education, so from the books of Calibre Education. Calibre Education sells to the school, so the school is a customer. Calibre Education buys from the computer store. Calibre Education banks with not FNB or Standard Bank, but the bank. And Calibre Education has its own premises, a little building, and Calibre Education also has a business vehicle. Calibre Education is a sole proprietor. So just some background when we do the videos. We're always going to look at the work in the videos from the point of view of Calibre Education, and these are some of the stakeholders in Calibre Education. Right, accounting definitions. You need to read through chapter 1. First of all, what is accounting? Accounting is a system based on the double entry system. For every debit, there is a credit. More about that later. Accounting records all financial transactions. We will look at what transactions are, and they record this information and they make it useful. Accurate records need to be kept in accounting, and all this information ends up in financial statements. A statement of financial position and a statement of profit and loss and other comprehensive income. You might know them as an income statement and a balance sheet. Right, this information in the financial statement is used by people like managers and owners, investors, banks, suppliers. More about that a little bit later. Accounting helps all these users make informed decisions, economic decisions. And you can see the use of all this information is whether the business is profitable or financially stable. Is the business in a good position? If you're an investor, is it a good business to invest in? So all these financial statements tell you more about the business. So we're going to learn through this year what accounting is all about, and we're going to look at a sole proprietor. Right, some more information on users and uses. So we have stakeholders in this accounting information, investors. People need to know if they invest in the business, or is there a good chance that they're going to profit from investing in the business? Employees need to know how the business is doing and how secure their jobs are. Labor unions like to see if their members are being treated fairly, so they look at the financials. Should employees be paid more? Lenders, people that are lending to the business, need to make sure that the money that they've lent to the business will be paid back. Suppliers need to know if they get paid. All this information is provided to the stakeholders. So these people here, the stakeholders, are informed of how the business is doing so they can make good decisions. The government's interested in the profit, so to see if the taxes are being paid correctly. The public want to know, is the business going to continue that they spend money at? Management need to know what's going on. How can they plan the way forward? And planning will take place based on what's happened in the past. So they need to check the financial statements. Owners want to know if their business is profitable or not, and a whole lot of other information. Owners are interested. So these here are stakeholders of the business, and they're interested in the accounting information. Why are they interested in the accounting information? The importance of the financial information. They want to know the financial position of the business. They want to know if the business is making a profit or loss. What are the costs of the business? They want to be able to plan based on what has happened. Are the policies in place the best for the business? Should certain work be done by other people who specialize in certain services? Outsourced? Should other people do certain functions of the business? And which activities are profitable, which products are selling, which products aren't. So you get users and uses of accounting information. Right, what does the word current in accounting mean? The current means the 12-month period during which the business is operating. For example, the enterprise's financial year runs from the 1st of January to the 31st of December. Now, financial year or financial period, the current period, can be any 12 months, any 12 consecutive months. It can run from the 1st of July to the 30th of June. This year is an example of a timeline which you will most probably make use of late in the year timelines. But this financial year is from the 1st of January, the current year, to the 31st of December. Current means the period in which we are reporting, and it's 12 months, the current 12 months. Right, what is an asset? Now, an asset is a resource owned. For example, equipment. It's a resource that is owned or controlled by a business as a result of a past event. Now, a past event would just mean I bought equipment for the business. Past event, bought equipment. Now, this equipment, in my example, is expected to provide future economic benefit. The asset is relevant to the business. I buy equipment for my business that is specific to my business, relevant to my business, and all the assets should be fairly valued. You can't overstate your assets. For example, after having the equipment for a year, I need to depreciate in my books the value of the asset. So there's a definition of an asset. And here's an example for Calibre Education: an office, a building, a vehicle, an asset that is an asset of the business. Cash is also an asset. and equipment. This laptop here is an asset. Those are examples of assets. And of course, if you sell to someone on credit, Calibre Education sold to the school on credit. If they sell on credit, then the school is what we call a debtor, and a debtor is an asset to the business, to our business. Assets are divided into non-current. Now remember, current means the 12 months that we are looking at. Now, if an asset has a lifespan of longer than 12 months, these three examples here, a vehicle, an office, and a computer, we're going to keep those assets for a number of years. They are called non-current assets. A non-current asset is a long-term resource a business owns or controls that is expected to provide economic benefit. So the difference from the definition of assets, this is a long-term asset. It's not current, it's non-current, long-term. It's a fixed asset. That's what it was called years ago. These are fixed assets, long-term assets, and now the modern terminology it's called a non-current asset. Then current assets are cash or items that are very close to cash. For example, this debtor, the school, Calibre Education sold to the school on credit. The school became a current asset. The school needs to pay us within, let's say, 3 months. So 3 months is smaller than 12 months. It's a current asset. We're going to convert this account of the schools into cash within 3 months. We're going to collect the cash. So a debtor is a current asset. So a current asset now is a short-term resource that a business expects to convert into cash or sell or use up within 1 financial year, within 12 months. That's a current asset. What is capital? Looking at a sole proprietor, owned by one person, a business owned by one person. Capital is the owner's financial investment into the business, representing the value they have contributed and what the business owes back to them. Let me explain that. So the owner puts money into the business, or the owner can put an asset into the business. So the owner made a capital contribution of a vehicle or cash. Now if the owner put 100,000 Rand into the business and nothing happened, the business would owe the owner 100,000. The interest in the business of the owners is 100,000. So it's what the business owes back to the owner. The money that they put in, obviously you're going to use this money to buy certain items that you need to operate the business. But the money that's invested by the owner into the business is the owner's interest in the business. Capital, that's one of the owner's accounts. What the owner puts into the business is known as capital. What the owner takes out of the business is called drawings. Now the owner of Calibre Education takes cash out of the business to buy something on the way home. That is called drawings. And the owner would take the money out of petty cash or the business bank account, but it would be recorded as drawings. If the owner takes stock for his or her personal use, it is accounted for as drawings. We don't write apples and bananas and etc. That's what the owner does with the money, but the owner can withdraw from the business. And remember, it's going to make the owner worth less. Capital is what they put in. Drawings is what they take out. So drawings are amounts the owner takes out of the business for personal use, reducing the owner's equity, the owner's worth. More about that as we go on. And these two accounts, capital and drawings, are known as proprietary accounts. And I just took an extract from the general ledger, which shows capital and drawings. Capital got credited and drawings got debited. But more about why an account is debited and credited as we move through this module. At the moment, we're just doing terminology and not why accounts are debited and credited. That will come. Those are accounting rules. Right, liabilities. You get different types of liabilities. Once again, non-current and current. Like you got current assets and you got non-current assets. Now, liabilities are either current or non-current, long-term liabilities. An example of a long-term liability would be a loan from the bank to buy a building, a mortgage bond. You're going to pay that back over 20 years. A current liability, an example would be the supplier. You buy from, I'll show you an example. Calibu Education buys from the computer store, which is a supplier, a creditor. That is a short-term liability, a current liability. So liability comes about when we borrow money or buy something on credit. Buy something on credit, buy now, pay later. The above two types of transactions result in the business owing money to either a financial institution or a supplier. So you're going to pay back a loan over time and you're going to pay back a creditor according to the terms negotiated, either in 1 month, 2 months, or if you're lucky, 3 months. So there you got liabilities, long-term and short-term, non-current and current. That means the same as long-term and short-term. So there's the bank. That could be a long-term liability. So we borrow money from the bank to buy a building, going to pay back over 20 years. You got the computer store. Calibu Education buys from the computer store to sell tablets to students. Going to pay them back in 3 months. That's a creditor, accounts payable, or supplier. Right, means similar things. So non-current liability, so long-term obligation to pay back over 12 months. For example, mortgage loan, home loan. Short-term obligation, a supplier, like the computer store. You're going to pay back within 12 months. Some more on liabilities. If we take, for example, Calibu Education buys from the computer store on credit, which results in a current liability. A liability is a present obligation you owe, so a business owes to another party, which must be settled in the future through payment, goods or services. Okay, normally payment. There is a transfer of an economic resource relevant to the business. So what happens is, let's say for example we buy stock on credit from the computer store. The resource is the stock and it goes to the purchaser, our business Calibu Education. In the books of Calibu, the computer store is a creditor and therefore a current liability. Right, what is a non-current liability? I did mention that earlier. Calibu Education, to buy this building, had to lend money from the bank, and the loan was for 100,000 and it's payable back over 5 years. because it's longer than a year, it is called a non-current liability. And that is a loan from the bank to finance the building. That is an example of a non-current liability. So the payback period is greater than 12 months. Right, equity. What is equity? Equity is the residual interest in the business after all assets have been used to settle all liabilities. So this amount here, they say, is the residual amount once you take the value, the leftover amount, once you take the value of your assets and you subtract the total of your liabilities. For example, Calibu has an office worth 100,000 and a car worth 100,000. That's 200,000 minus the 100,000 owed to the bank. That's your liability, is equal to 100,000. So what is the owner's worth? The owner's equity, the value of the assets minus the value of the liabilities. Owner's equity is equal to, another way to calculate owner's equity, what the owner puts in plus the income the business earns in the sole proprietor less what the owner takes out minus expenses. Owner's equity is equal to capital less drawings plus income minus expenses, or the value of the assets minus liabilities. So there are two ways to calculate equity. More about that when we do some calculations. And a good way to remember what owner's equity is worth is use the acronym DICE. D-I-C-E. Capital plus the income minus drawings minus expenses is equal to owner's equity. And to remember the components, DICE will help you remember capital, income, drawings, and expenses. Just put this in here. Owner's equity, the left-hand side is equal to the right-hand side. Owner's equity is equal to the value of the assets minus the value of the liabilities. What you do to the left-hand side, you must do to the right-hand side. This equation, what the owner is worth, at a later stage will be changed into the accounting equation. But what you do to an equation on the left-hand side, to keep it equal, you must do to the right-hand side. So if I add one caterpillar to the left-hand side, what must I do to the right-hand side? Add a caterpillar. Right, that's not on a serious note. It's just adding a little bit in here, but what you do to the left-hand side, you must do to the right-hand side of an equation, so they're still equal, balance. Right, what is income? Now, income is the money a business earns from its main activities, selling goods or providing services. You get a trading concern that buys and sells goods, or you can provide a service. Now, Calibu Education, what that is there, is it sells digital products. A barber cuts people's hair, right? In order, it's a service, or a lawnmower service. You can earn income from investments. So here are three ways in which a business can earn income. Sale of digital products, services rendered, investments. That's how you can earn income, 3 ways. You can have commission received as well. Right, expenses. Expenses are the costs a business incurs to run its business. Right, so you're going to have costs to make sure that you can generate an income. An expense is the term for the costs of a business. During day-to-day business, items are used up and costs are incurred for the business to function. For example, stationery, advertising, salary, fuel, telephone. If you didn't have those expenses, the business would not operate. So expenses are the operating costs of the business. This vehicle of Calibre Education uses fuel. That is an expense to Calibre Education. There, that car's disappeared. Right, I'm going to look at profit, and then I'm going to stop this video for today, because with videos it goes very quickly. You can watch these. This is accounting terminology, and we'll carry on with that at a later stage. Profit. What is profit? Profit is when income exceeds expenses. Now we checked what income was and we saw what expenses were. So if we got our digital products, we sold all these items and we had expenses like fuel, the income, if it is greater than our expenses, that is going to equal a profit, right? A profit. Income must be greater than expenses. Note, assets and liabilities are not included in this calculation of profit. So then what is a loss? A loss is when the expenses are going to be greater than the income. Let's have a look. That says income. The income is less than the expenses, and that will result in a loss. Right, we've been going for 33 minutes. I can cover a lot of work like this in a video. Normally in class it would take about an hour, maybe a little bit longer. So what you need to do, you need to watch this video. You have already if you've got to this stage. And then there will also be a link which is not working at the moment, but hopefully it will by the time you've watched this video. You need to click on the link to say that you have watched the video, and it's your registration to prove your attendance in this online space. So there will be a link you will see. You will need to click on that link and you would have to submit the attendance form. I hope you enjoyed this video. At the moment this is how it's going to be, but hopefully soon we'll meet face to face. Read chapter 1 in your textbook. You can go back and have a look what textbook that was. It's available at Van Skyks. It should be available by now. I look forward to meeting you all in the class. Chat soon. Cheers. Bye.